Not being able to hit the sell button is the biggest reason. It goes down to discipline, but I just like to put it this way. The ability to not be able to hit the sell button is what separates you from actually making money and the reason why you always lose. So how do I choose a strike price? So when I'm doing something along the lines of an option trade, so let's forget about equities for a second. So what I like to do is I like to generally get something that's close to the money. So for this RIOT play, I played $30 weeklies. Now, why did I play $30 weeklies and when did I take them? So I took them right here, right when I said that Bitcoin was turning, which was right here. I drew this line that I thought it was going to go up. So this is where I took my call. So you're probably saying to yourself, Stocky, the stock was at $29 and you took a $30 weekly, right? A $30 weekly. Now, that's not really at the money, normally speaking, because $30, a dollar per share, if it's $2.90 is 10 cents, right? Or 10%, right? $1.85, 5%. You're talking about 2-3% out of the money. Normally, you would never take something that far out of the money because you're not thinking about dollars. Remember, a lot of you guys, when you're looking at stocks and you're looking at equities, you think about the dollars. You think about, oh, it's how many dollars because you're looking at the option, right? You're thinking, oh, well, the delta, right? The delta of an option. So let me show you. The delta of an option, if you don't know what I'm talking about, I have YouTube videos on this. The delta of the option tells you how much the premium of your contract increases per dollar the equity goes up. In layman terms, how many dollars, how much, sorry, how much you make in your option contract for every $1 the stock goes up, right? So if your delta is 45, if the stock goes up $1, you make $45. Now, if it's a $400 stock, much different. If it's a $10 stock, you're breaking it down in the pennies, right? There's many other factors there. So RIOT is a stock that we've seen move 10-20% in a day. So when I look at out of the money, I never look at how many dollars out of the money something is. I only focus on dollars as far as the delta, never when I'm purchasing the contract. I care about the amount of delta to theta if I'm holding overnight or how much there so I can keep track of how much it's going to go up per 10 cents or a dollar. But when I'm actually looking at a strike price, I don't look at the dollar, I look at the percent. Right? Because a lot of times, people will say, well, that's only $1 out of the money. But on a $10 stock, that's 10%. Sure, you just played NVIDIA, where a dollar out of the money was 0.2%. Totally different perspective. The value of a contract is how likely it is to get to within the money at the strike price. So I took a $30 weekly. Why did I take a $30 weekly? Couple things, okay? Couple things. Number one, I'm not going to explain why I took RIOT because I already explained that, but here's the thing, okay? This was at $29. I took a next week or this week expiring $30 call. Why did I choose $30? There are 3 reasons why I chose $30. Now, I would never take a weekly if I planned holding this overnight. I didn't plan on holding it overnight. It was only a day trade. So I didn't have to worry about theta, right? I didn't have to worry about holding it overnight because theta was crazy. Why? Number one, okay, strike price, all right? Yeah, strike price was 2% out of the money with 1 week to go. But because I know RIOT can move up or down 10 to 20% in a day, that's achievable. Okay. Number two, the amount of volume I saw in Bitcoin showed that it looked like it was going to make a parabolic move. And if that happens and RIOT falls in, the faster it moves up, the more money you make. If it goes up 1% in 5 minutes, you will make more money than if it goes up 2% in 30 minutes. Do you understand? The reason is because the ask bid, the volume, the open interest, people FOMO in, or computers or firms, they FOMO in, they have to jump in and they have to pay whatever they want because it's parabolically moving up. And therefore, the implied volatility also goes up. And as the implied volatility goes up, the premium on the contract goes up. And people are chasing it to the upside, so they have to pay more. They can't put in a low bid. So it drives up the price of that contract significantly. So if it's doing this, it's going to make a lot more than if it starts doing this. Okay? There's more value made here than here. Okay? Now, with that being said, why did I take the $30 in particular? I could have taken a $32, but the 32 was 0.47 a contract. The 30 was 1 per contract. I could have taken something deeper in the money, but because I'm only playing a scalp, I want to get the most bang for my buck. And therefore, I need something with a high delta, right? The more out of the money, the higher the delta. But the other thing is that I was spending $2,500 worth. So if I spent this is 25 contracts, and this is, let's say, 50 contracts, right? I pay 65 cents per contract in and out on commission. Not that commission matters, but as much, but I want to throw it out there. So that means I'm paying $1.30 per contract on execution. So if I break even on this, I lose, 20, I don't know, 30 bucks or whatever. Here, I'm losing 75 bucks, right? Now, in the grand scheme of things, when you're paying $2,500, it's not as big of a deal. But it's something that factors in, especially for those of you guys who play like a $25 contract. If you don't make money, you're losing out on commissions as well. So there's several factors that went in. The reason I took once again, to break it down, the TLDR, the reason I took $30 is because it was out of the money, which gave me a higher delta, okay? But not too far out of the money where if it didn't move enough, I wasn't going to, because remember, the further it is out of the money, the less likely it is to get to the money, the less people want it. And it significantly falls off in value as it starts to what we call flatline, right? The closer to the money, the more chance it has to still get there without having to make a parabolic move, so it holds its values longer, okay? That. I wanted something that had a high delta, but I didn't want to overpay for the contract. At the same time, I didn't go too far out of the money because I want to make sure that if I'm wrong, I still hold value that I can sell and get out with a major loss. Delta's higher in the money. It can be higher, but not necessarily. So delta can be higher, but it's also on a parabolic move, it's less likely to be because remember, delta's higher in the money, but you have less contracts. So for example, if you can afford 5 contracts and the delta's $50, or you can afford 20 contracts and the delta's $40, and it moves up $1, where are you going to make more money? You make $250 here, okay, but you make $800 here. So the delta is higher, but you afford less contracts. So it's about safety versus risk. Can you explain how you calculate call prices like you did yesterday with plug pre-market? Yeah, so the way I do that is I explained it yesterday. I'll show it to you again. So it's not a guarantee because there's too many unknown factors, right? But it can work in your favor. So what you do is how do you calculate an option? Let's say you want to get into an option at open, right? The problem with trying to get into an option pre-market by setting an open order is that you have no control over it, right? You have no control over it. Maybe it gets filled, maybe it doesn't. You're picking your price. How do you do that? Let's say you're in stock, okay, ticker DEEZ. And you look at the Greeks and you see the delta is 50 and the theta is 20, right? The stock is at $10, all right? And pre-market, you see that it's trading at $11, right? Last night's close was $100 a contract. So what do? You just calculate the bare minimum, which is, okay, if it was $100 yesterday, it's going to go up $50 per dollar that the equity goes up. It's up $1, so I'm going to add 50 to that. So that means 150. But now I have to minus the theta, the amount of value that contract loses each day at open, minus 20. So that gives you a 1.30. Now, this isn't going to work every time. And sometimes it will work, and then you'll lose money right off the bat because, you know, you picked it open and then there's a candle drop. Or there's so much interest that let's say the people that are selling your ask people, they're selling it for 200, right? And the bidders are coming in at 140. Your average price at open is going to be 170. And your 150 is never going to get filled. You see what I mean? Basically, that's what you're doing. Also, IV can change, open interest, volume can change, the ask bid can change, everything can change. But that's the rudimentary way of doing it. It's basically just adding the amount of delta, minusing the theta to the closed price, and then winging it. Implied volatility. So implied volatility, those of you guys who know, everybody knows, but basically implied volatility is very, very difficult to calculate completely accurately because it moves as the contract moves. But implied volatility equals expected movement. Okay? All right, so when you're looking at expected movement, the idea is how much do we expect this contract to move between now and its expiration, right? So certain things can price in. For example, if you buy an options contract that expires on August 20th, but earnings of D's is on 8-1, we're gonna the IV is gonna go up, right? Your IV is gonna be higher as opposed to a contract that expires without that, because with earnings, you're expecting most earnings have significant movements, whether it's 1, 2, 5, 10% up or down. So now all of a sudden, the expected movement goes up. Why does the expected movement go up? Because you're expecting that underlying equity to move, which is going to move that contract, right? So that increases implied volatility. Apple comes out of nowhere and announces a surprise conference. IV goes up. The stock has unusual volume and just starts increasing significantly higher or lower than its normal movement, or volume is higher than normal. We're expecting more movement. Therefore, IV starts to jump, and the longer the sustained uptick is, the more the IV goes. Why does IV matter? Well, your IV adds value to your contract. The higher the implied volatility, the more premium, the more value your options contract gains. And if that stock, this is why I tell you guys, if it starts to flatline, you're going to lose value. The stock didn't go down, but you're losing value. Why? Because now that expected movement, that huge parabolic move to the upside is kind of slowing down. So now we're not expecting as much movement, and therefore expectations go down, right? Kind of like when somebody sees your Tinder profile picture and sees you in real life. Very high expectations, and then sees you, and that's what we call the IV crush, right? And so an IV crush, and this is why you guys got to be careful playing options through earnings or through events, is because once that implied movement, that expected movement disappears, all that value that was added to your contract also disappears. So for example, let's say D's is going into earnings and implied volatility is 110%. Well, the next day when those earnings are over, that catalyst, all the value that was added to your contract, which is now $200, and let's say $50 of that was only added because of an increase in implied volatility or expected movement. Once that event's over, that movement is no longer expected, that's all gone. So now you price that in. That's gone. So if you bought at 2, somebody sold it to you who was in and got all that sweet, sweet money, you lost that. Now you're reliant on all the other Greeks and the movement of the equity. And so that is why I tell you guys all the time, don't fuck with options through earnings or through events. Because even if you're right, you can be wrong. Because if your implied volatility is 100%, they're expecting 100% movement. And the options contract is 200, right? And you go through and the stock, let's say the delta is 40 and the theta is 10 and your implied volatility, you go through, okay? even if you're conservative, and this is what I do, I always cut 50% of implied volatility. More if the closer to expiration your contract is, the more implied volatility I just automatically disappear out of my head. So what I say to myself is, let's say this is a month out and the earnings are going there. I'm already minusing 50% of this value gone. So I automatically assume I'm already going to start tomorrow down 50%. So what do I need to make that up? I need $3 in movement to the upside on the equity through earnings to give me 120, right? So this, let's say there's no gamma. Minus the 10 for theta, 110, right? Add the 110 to the 100, that gives me 210. That means if I buy this at 200 and I'm holding through earnings, I need this stock to go up at least $3 per share for me to even crack green. Am I just getting too deep now? All right. So that's how I calculate earnings. So oftentimes you guys will see me and you'll say, Stocky, how come if earnings are tomorrow on 6/24, why did you buy an 8/20 contract? You paid so much more money for it. And the delta is, you're not going to make as much money per contract. Yeah, but I'm also, if I'm wrong, I have time for it to recover, or it's going to lose less money because of implied volatility isn't going to be as high because we're not expecting as much movement. Also, my theta is going to be significantly. You got to remember something, and this is something a lot of you guys forget. The two biggest mistakes traders make, options, equities, doesn't matter. The number one biggest thing that hurts traders is what? I don't know why I put the number one. I should just put the biggest. It's not being able to hit the sell button. This goes for when you're in profit, and this goes for when you're in loss. Not being able to hit the sell button is the biggest reason. It goes down to discipline, but I just like to put it this way. The ability to not be able to hit the sell button is what separates you from actually making money and the reason why you always lose. Let's stock him up 10%, then sell. But what if it goes to 20%? Then sell half. But then half of it won't make money. All right, don't fucking sell it. Stocky, I'm down 20%. What do? I should have sold. Well, sell now. No, but what if it goes back to even? But what if it goes down? Now I'm down 50%. Like it's a perpetual cycle. It's a perpetual cycle. All right? The second biggest issue, okay, is not preparing for being wrong. As Mike Tyson once said famously, everyone has a plan until they get punched in the face. Okay? No one wants to price in if they're wrong. They only focus in on if they're right. I spend more time calculating my exit strategy if I'm wrong than my exit strategy when I'm right. I spend way more time on that.
Grammar Dave donated $6. I am down 50% on these nuts.
That's funny. Your mom goes down on nuts a lot too. All right, regardless. All right, so I spend more time. All right, more time planning on what if I'm wrong.
$6. Boomtown.
I'm not toxic. Okay? But that's not gel she's using lately. All right, so I'm just saying, you gotta have an exit strategy. Not just on the upside, but on the downside. Sure, you may sell and it may moon after you sell for a loss. But I'd much rather cut my losses early and it moon than to hang on and watch it fall. Once again, and I've said this a million times, I'll say it again. You buy a stock here, the stock gets here. You set your goal and you said, I'm going to sell here. But you don't sell here because you think, what if I sell here and it does this? So you hold and it does this. Stick to your plan. There is a reason why you see me go into a play, take my profits, and walk away. Sure, I leave money on the table. Yesterday, I left $22,000 on the table. The day before, I left $15,000 on the table. But that's because you guys weren't here for the times when I held, and instead of being plus 2K, I finished the day negative 7K. I'd rather miss out on $5,000 of potential profit and lock in $2,000 than walk with a $7,000 loss. Because just like anybody who's ever been poor or had been in financial situations will tell you, and I'll say it again, $1,000 is not a lot of money to have. But it's a hell of a lot to owe. And it's the same thing with trading. It's a lot easier to walk away with a 1% green day when you could have had a 3% day than it is to walk away with a negative 3% day when you could have had a 1% day. And if you focus on it, you'll always keep chasing. And you'll always keep losing. I sit through the bad mom jokes for this. No, you will always chase. I don't care what you think you are. I don't care who you are or what you think you are. You will get into a perpetual cycle that you will not get out of. It is a very simple cycle that I have seen and I have been part of. Everything I'm telling you guys, I've been there. This isn't me standing on some soapbox talking down to you. I've been there, not just my socioeconomic, not just through poor and not just through money problems, but through bad trading habits. I'll never forget when I had $10,000 and I made one bad play and I lost 10% in one day. And you know what I did? The next day, instead of focusing and saying, hey, I have a $9,000 portfolio, let's do this. I said, no, I lost $1,000 yesterday. I need to get that back. Well, how do you get that back? You go big.
Since you're being so serious, just wanted to say your mom.
All right. I lost $1,000. That's 10% in one day. That's fucking crazy. So you know what I did? Instead of just, because I always tell people what I do, I don't look at how much money I had. I never look at my balance from yesterday. I open up my brokerage in the morning. I see how much money I have, and that's how much money I have, and that's what I'm working with. I don't look at the day before. Because if not, I'll do what I did when I was younger. Lose 10,000, so what, or lose 1,000. What do I need to do? I need to make that up. What does that mean? That means I need to make 11% today. Instead of focusing on making 1% or 2%, I got to make 11% today. So what do I do? Well, it's easy. I'll just take all 9,000 and go into a play or a couple plays, and all I got to do is make 12%, and I'll get my money back from yesterday and make my 1% gain. So I throw all $9,000 into a risky play because you need risky for that kind of money, and it goes wrong. In 2 days, I've lost 30% of my money. Well, now I got to go riskier to get it back. I have 1,000 left in 2 weeks.
Dave donated $6. Ted Lassou says, "Be a goldfish."
Exactly. Now you're down 90% and you have $1,000. How many of you guys in here have done some shit like this, whether it's in one play, one day, or 1 week, and look back and said, God damn it, if I would have just fucking sold. If I would have just fucking sold instead of kept doubling down or kept holding. And the question is, how many times will you do that until you make a rule and stick to it?
Plan capper.
So when something has lower volume, right, on options, right, when there's not a lot of contracts out there and there's a large ass bid spread and you own it and the underlying equity is starting to move, you can kind of not manipulate, because that's not the right word. You can kind of dictate a little bit of the movement of those contracts. So for example, let's say you were in, what's something that has low volume generally? Let's say it was Hog, right? So Harley Davidson, okay, generally has low volume. And let's say you had 6 contracts, all right? And Hog is starting to make moves, and the stock is starting to move, and you're starting to see interest come in there. And the bid is 100, and the ask is you. You decide the ask, right? And you start seeing interest in here. So the ask was originally, you have an ask in there at 150. That's a pretty big spread. It's a 50% spread. That's huge. So your average is going to be 1.25. No one's actually going to buy that, okay? But all of a sudden you start seeing the volume to start ticking up, and you start seeing people come in. Now what you can do is, instead of putting all 6 contracts at 150, you can go in there, start from the top to the bottom, and put 2 at 180, 2 at 160, and 2 at 140. Now, the reason I say that is that you now control the top side. Now, if there's a lot of volume and people own a lot of the contracts, it could fuck you up. But in that short-term spurt, you own that. So now the ask actually drops to 1.40, right? That drops the ask to 1.40, which actually drops the value of the contract down to 1.20, but it makes it more attractive buy. And as that volume increases, and then as that underlying equity starts moving up, and people want to jump in, you're the only one selling it. And if that's the case, they have to pay 140. Well, guess what? They bought it from you from 140, but guess who owns the next bid or the next ask? You at 160. And so that raises the value of all your other contracts, but at the same time, you're basically laddering it up. So instead of somebody else coming in there and determining what the ask is, you automatically determine the ask. So that's something that can be done. Now, don't do it, because obviously if somebody buys your 140 and turns around and flips it for 150, you're now priced out. But it's something that, like, for example, let's say I have something and I want to sell it, but I'm not sure if it's going to keep running or not. You're not even trying to dictate it. You're just protecting yourself. It's kind of like, you know, I have 100 contracts of space, and it's doing this right now, and it's starting to move up. I may take them and put 20 every $10, you know, and I may do that, and then that way these get chopped up. And then it moves up a little bit, I'm the next ask. And so people have to buy from me on the way up. But something like space is so fucking crazy right now, you wouldn't be able to even, it wouldn't even matter. It's not about you anymore. Sorry, you're not as important as you thought. Do you raise your sell exit as it keeps going up, or hold the lower sell? Depends. If I'm in something like a long dated leap, I generally like to leg out, or I'll set myself a point where if it starts moving parabolically early, what I do is I like to do what's called the split, right? So what I will do on something like that is this right here. So this is something I've done in the past. It's worked out well for me. Sometimes it's worked out terribly for me. So it just depends on each individual play. But here, let me show you what I'm talking about. All right, so what I do is if I'm in something that goes parabolic, I did this with Ford, right? I did this with Ford leaps. So if I'm in something that's a leap, like a year out, let's say I buy a $150 contract and it expires 1/22/22, right? Or 1/22. So January of next year, right? So I'm expecting this to hold for a long time. But in 1 week, the underlying equity goes up. Let's say I have 10 contracts at 150, right? And it jumps. It goes insane. And I get up 100% in a week, I sell half. Now I have 5 at 300. Now I have sold my initial investment. I've sold half and covered my initial investment. Everything else is house money. And now I just split on the way up. Let's say it goes up another 100%. Let's go, it goes to 600. I'll sell 3 or 2. Let's say 2. I'll sell 2 at 600. Now I'm still riding 3 at 600. Well, guess what? That right there, that's $1,800 worth of capital, but I've already sold my initial $1,500 plus an additional $1,200. So now I've taken out $1,700, or sorry, $2,700 in actual realized gains, and I'm still riding with more than my initial investment. And if for some reason Ford comes out and says, hey, I'm sorry, but our CEO died in one of our electric vehicles because there was a malfunction. Also, he was in there with an underage Thai boy or something, and it goes to zero, guess what? I lose this $1,800, but I still walk away with my initial investment plus $1,200. So I've got $2,700 in capital, $1,500 of which was my original, and I'm still riding $1,800. This might keep going up. What if it goes up again and it goes to $1,000 or $1,200? I might sell one and now ride two and just keep going like that, right? No, I'm not gonna buy more unless it falls and I'm still a big believer in it. But other than that, no, you know, I mean, it is what it is.